welcome to Financial Planner right here on Business Television India. I'm Fatima Mehdi, and joining me on the show today is Arjun Guha Thakurta. He's Executive Director at Anand Rathi Private Wealth Management. Arjun, thank you for speaking to us right here on the show. Today, I would like for you to weigh in with us in terms of what asset allocation is and how it really is essential to handling market risks and volatility. So how would you define asset allocation, Arjun?
Fatima, let's first start by defining what is an asset. An asset is a resource with an economic value that an individual owns with the expectation that it will give a future benefit. Now when we've defined the asset, let us then look at what is asset allocation. Asset allocation is the implementation of an investment strategy that tries to balance between risk and reward by adjusting the percentage in each asset class, keeping in mind three very important things. The first is the goals of the client, the second is the risk appetite of the client, and third is the investment time frame of the client. Which is why when we advise our clients, we tell them to look at investment decisions not in piece or in piecemeal at all, but it should be looked in general as a whole, which again should emancipate from the goals and the objectives that he started to follow. It should start from the goals setting and the objectives, and from there should one take the asset allocation.
Okay, so are there so it appears that one is really looking at sub decisions here when you're making that initial decision for a financial investment. Can you break it down for us? I mean, I'll give you an example of the common wish to buy a property. How is that deconstructed when it comes to how it works with the sub decisions when one is looking at, say, buying a property?
So when you're looking at any financial investment decision, you're actually taking three subdivisions. Coming to an example of somebody willing to buy a property, say a 4 BHK property, say in Bandra or anywhere in the country. The first decision that the client has taken, that he's chosen the asset class which he wants to invest in, which is real estate. The second decision that he's taken is to buy the 4 BHK property, which is nothing but a security selection. He could have gone for a bungalow or he could have gone for a piece of land, but he's chosen a 4 BHK property as a security selection. And the third thing is he's decided to buy it now, not 6 months earlier or 6 months later. So any decision that you take on the financial space, you're basically taking three decisions. And research normally shows that 90% of the fate of your money depends on the choice of asset allocation rather than the product or the timing of the same.
Okay, Arjun, tell me a little bit about how asset allocation, how does that work in terms of the amount of money one makes or the amount of money one earns? I take your point about how choosing the right asset is more important than the product and timing of it. I mean, property, of course, is one of the best examples of that. But can you tell us a little bit about the kind of different attributes assets have?
Yes, because by this asset allocation, the clients make substantial higher returns. Let me give an example. Different asset classes have different attributes. For example, a physical asset like gold or a financial asset like fixed income acts as a natural hedge against equity, which in turn protects the clients from the downside, and then that in turn helps them to stay afloat to make higher returns in future. So asset allocation does play a very important part in making returns.
Okay, Arjun, a little bit about, I'm asking you about some of the conventional assets that, we've seen Indians over the years, of course, invest in. I mean, of course, that trend has changed towards equity now, but I want to just come to gold for a minute. How has gold really worked as a physical asset? It has traditionally been a hedge. How have you seen that sort of being used and worked recently?
So what happens, I'll come to the recent part a little bit later, but typically there are four asset classes worldwide. Couple of asset classes are called the defensive asset classes, which is nothing but fixed income and precious metals like gold. The other two asset classes, which are growth asset classes, are equities and real estate. Now research shows us that over a period of over years, we as Indians have an inherent love towards physical assets more than financial assets. And close to 60 to 70% of the financial savings were going into physical assets rather than financial assets. Worldwide, this trend is absolutely the reverse. People invest worldwide around 20 to 30% of their money in physical assets. Coming to your question on the gold, I think gold has lost its sheen over the last few years, and even on the hedge part of it. So I would recommend clients not to keep a very large allocation in gold for the time being.
Okay, so not that hot on gold at the moment. Can you take us through a little bit in terms of what your observations have been in terms of how Indians are investing? Typically, I mean, if you could sort of tell me a little bit about how real estate, gold, deposits, equities, how is all of that sort of working in the mix at the moment? What are the trends that you're seeing?
So what we've seen in the past is, if I look at the chronological order, Indians first will buy real estate, then they look at gold as an investment option, then deposits, and finally then they move to equities. However, this trend is changing over the last few years, and which is being seen in the amount of SIP monies which is coming into the markets. Equity is something which people are looking at more and more, keeping in mind that real estate isn't the best asset class to be in going forward. So you have more and more people investing in equities.
Okay, fine. All right. We know that Indians actually have about 60 to 62% of their total savings, I understand, in physical assets. Globally, the number is so much less. I believe it's a fraction of it, like about an 18%. I guess what you're also saying is that we're sort of moving towards that on some kind of trajectory over there. But can you tell me a little bit more in terms of the whole relationship of what age equity and debt should be? I mean, in terms of percentages, I mean, I'm assuming the younger you are, the more equities you have, but really how much is that gradation as we move up the decade, so to speak?
So Fatima, yes, age is one of the indicators when you're looking at deciding the asset allocation, because the earning capability of an individual reduces as one progresses in life. However, these are very, very broadly defined indicators. So if I look at an age band of 25 to 35, I would recommend them to have an equity allocation of 70 and a debt allocation of 30. People in the age band of 35 to 45, I will recommend them an equity allocation of 60 and a debt allocation of 40. People in the age band of 45 to 55, I would recommend 50-50. And in the age band of 55 to 65, I would recommend equity as 40 and debt as 60. However, these are broad-based indicators, keeping in mind the current scenario that we're going through equity and debt. Left to me, asset allocation is a customized variable, and one size fits all doesn't work on asset allocation. Every individual should go through the asset allocation process and then decide which size fits in.
All right, Arjun, wonderful talking to you right there. I mean, you've really taken us through some of the basics as well as the thumb rules, given the fact that we are looking at an interesting environment when it comes to investments. But as you were saying, one size doesn't fit all, and there is, of course, a lot more to be discussed here. Arjun, thank you so much for giving us this time right here. That's Arjun Guha Thakurta from Anand Rathi Private Wealth Management, joining us to speak to us on the show. Thank you for watching.